Hi, I'm Conner Gyllenhammer, Associate Portfolio Manager here at Nottingham Advisors. I'm joined by my colleague, Peter Kazmierczak, Associate Portfolio Manager, and today we're going to discuss last month's market wrap. Peter, thanks for joining us today.
Yeah, thanks, Conner. Happy to be here.
So first question I got for you is, how do you see the markets reacting to fears of a looming recession?
Yeah, so we saw the second quarter post a GDP decline of negative 0.9%, following the first quarter's decline of negative 1.6%. While this does fit the historical technical definition of a recession, the National Bureau of Economic Research has recently broadened its actual definition of a recession to include the qualitative component of a significant decline in economic activity that is spread across the economy and it lasts more than a few months. So a bit subjective as to where we are currently right now in the market cycle. But the market actually did react quite positively to the second quarter GDP number. And that's because the number wasn't as bad as some market strategists were calling for.
Interesting. So the Federal Reserve said several large rate hikes this year, totaling 250 basis points. Do you think this is enough to lower inflation and provide some relief to the U.S. economy?
So what's interesting about this question is that prior to Friday morning, we probably would have said that it's likely that the Fed can relax a bit on their 75 basis point rate hike increase that they've been doing at each of their recent meetings. However, on Friday morning, we saw the July jobs number come in at almost double the forecasted amount. The U.S. economy added 528,000 jobs in the month of July, and the unemployment rate dropped to 3.5%, which matches a 5-decade low. In our most recent market wrap, we noted that bad news in the short term could prove to be good news in the long run. Well, kind of the opposite happened here, where what looks to be really good news, which is adding a ton of jobs, this could possibly have a negative impact on the normalization of rate hikes moving forward. Powell hinted at their most recent rate hike meaning that the Fed could slow the pace of rate hikes, but now where we stand today, the market is pricing in a return to that 75 basis point rate hike in their September meeting.
Seems like only time will tell. So moving on to the equity market, how did stocks do in July?
So U.S. equities breathed a sigh of relief in July. This really comes on the back of better than expected earnings news and a potential Fed pivot. The S&P 500 index closed out the month on a high note, gaining 9.2% to close at 4,130. This represents the highest monthly return since November 2020. Mid and small cap stocks, they also rallied sharply, with the S&P 400, which represents mid caps, gaining 10.8%, and the S&P 600, representing small caps, gaining 10% flat. From a style perspective, the S&P Growth Index rebounded sharply on the month, gaining 12.8%, while the S&P Value Index rose 5.91%. Year to date, though, value is still outperforming growth by roughly 12 percentage points. From a sector perspective, consumer discretionary surged almost 19% on the back of a positive earnings release from Amazon, which represents a quarter of the sector market cap. Tech returned 13.5%, driven by positive releases from Apple and Microsoft. Apple had a more muted impact from China than some were expecting, and Microsoft shared positive guidance for future earnings outlook. Energy and industrials, they were some other strong performers as resilient economic activity added to record profits for Exxon and Chevron. However, defensive sectors such as consumer staples, healthcare, and utilities lagged other sectors during the month of July after being leaders for most of the first half of the year. However, where we stand today, as we've seen throughout this earnings season, we've seen pretty minimal earnings estimates to cut for 2023. As we stand here today, earnings estimates have only been cut from $252 to $246 for the S&P 500 for the year 2023.
Okay, thanks for that robust answer. So what about the fixed income market? How did that perform in July?
Yeah, so we saw government bonds posting positive returns in July, less so than other risk assets. With Powell's tone shifting to be a little bit less aggressive, the risk rally kind of created a strong tailwind for the risk bond exposure. This caused credit spreads to come in and tighten a little bit for investment grade credit, and even more so within the high yield space. Munis also caught a bid, raising a bit more than similar maturity treasury bonds.
Okay. Last question I have for you, Peter. Is inflation here to stay?
So while I know that the word maybe isn't probably the most appropriate answer for what we're doing here, but I would have answered that honestly a little bit differently at the end of last month. With the jobs number that was posted on Friday, a little bit more concerning, and it shows that the Fed still has some work to do in cutting labor demand. We've seen prices for goods begin to come down a little bit, which has been positive for the U.S. consumer. However, we're still waiting to see that same price action movement from the services space. And unfortunately for the U.S. consumer, services prices tend to be a little bit more sticky.
Time will tell, right? And that's all the questions we have for today. Peter, thanks for joining us. Until next time on Market Wrap Recap.